So in this we will see about this chapter is all about cost of capital. Now what do you mean by capital first of all? So capital means capital can be in the form of equity or debt. Now how does an entity raise funds? Through equity or debt or through preference shares. So it can be in the form of equity, debt or preference shares, or it can be in the form of bonds or debentures. So capital is basically the source of fund. So source of fund which helps the entity to run their business. It can be in the form of equity, preference, debt, bonds or debentures, etc. Now this chapter is all about cost of capital. Now what is cost of capital? Cost of capital is nothing but overall cost of capital that the entity incurs. For example, if you raise through equity, you will have to give return to your investors. If you raise through preference shares, then in that case you have to pay preference dividend. If you raise through debt, you will have to pay interest. If you raise by way of bonds or debentures, by issuing units, then in that case you will have to pay interest. Now this is basically a cost for the entity. So entity will have to incur cost on this, an equity, preference or debt, bonds or debentures. So this is basically the cost of capital. Now you raise funds through these modes and then you invest in your business or basically the project, and then you get returns from the same. Now what is considered to be a best investment? So one which gives you higher rate of return. That is, the cost of capital can be noted as K0, overall cost of capital. It is basically overall cost of capital, or it can be also denoted as weighted average cost of capital. Now why is this name weighted average cost of capital? Let's look into that. But before that, so you raise funds through these modes, you invest in your business or project, and then you get returns from the same. Now usually these returns will have to be higher than your cost of capital so that it's beneficial. So generally you will accept a project if the return is more than or equal to overall cost of capital. But if it's less than overall cost of capital, then it means that you're incurring loss, in which case you will not accept the project in the first place. So how do you calculate? Now this chapter is all about cost of capital, as the name suggests. So wherein you will have to calculate this K0, this overall cost of capital or weighted average cost of capital. Now how do you calculate this? So overall cost of capital, or how has this name come, that is weighted average cost of capital? Let's look into that. Now you raise funds through equity or debt or preference. Let's take for example, this company has raised through equity, through debt and through preference shares. Now first you will have to find the cost of each of these instruments. Like take for example, if it's for equity, then you have to find out the KE, which is cost of equity, and then you have to find KD, which is cost of debt, and then KP, which is cost of preference shares, and then weight. Weight is nothing but proportion. What do you mean by weight? Right. So for example, let's take for example equity total value is 1 lakh, which we are writing by way of 1 to 100. Okay, 100 in thousands. Okay, weight in thousands. And then debt is 200. Let's take for example preference is 300. Now what's the total amount? I want you to calculate this side by side in your calculator as well, so that it will be easy for you to understand. So which comes to total of 600, right? 600. Now this is 600, and what about the weight? Weight is nothing but your proportion. So this is the amount, and what about the weight? Weight is nothing but proportion, which is nothing but, okay, so these are the amounts, and what about the weight? This amount can be either face value or it can be market value. Face value or book value, or it can be market value. It totally depends. I mean, weight, in certain cases we will take that to be face value, in certain cases we will take that to be market value. Weight is, in this case, will be nothing but 100 by 600. That is 100 out of 600, just 16.67%. Or it can also be written as 0.1667. And 200 by 600. Weight is nothing but the amount of debt to the total capital, which is nothing but 33.33%. And next, preference is nothing but 0.5. And then let's take for example KE is, let's take for example the cost, something but 10% over here. Let's take for example it's 20 and it's 25%. Now how do you calculate the K0? K0 is nothing but weight of equity into KE, weight of debt into KD, weight of preference into KP, and that's how you get the overall cost of capital. So let me just write it here. Overall cost of capital is nothing but so why do we have to multiply this by proportion? Why not, like take for example this is K, this is KD and this is KP. So if we add all the three, how much do you get? you get 55. Why not divide this by 3? Because this equity and debt and preference within the entity is not in the same proportion, right? So this is not the equal proportions, it's in different amount, which means that for each of the cost of the capital, namely equity or debt, we will have to assign them different proportions or weights. Like this is only contributing 16.67%, whereas this contributes 50% of the capital. This contributes 33.33% of capital. So how do you calculate the overall cost of capital? You take KE, cost of equity, into weight of equity, plus cost of debt into weight of debt, plus cost of preference shares into weight of preference shares. So which is nothing but over here, cost is 10 into weight is 0.1667, which comes to 1.667, and in the next case it will be 6.67, and for the next it will be, we multiply the weight of preference into cost of preference, then it comes to 12.5, and the total is nothing but, it comes to 20.84%. So this is how you compute the overall cost of capital. That is, you multiply the respective cost into their respective weight proportion, which can be based on book value or market value, which totally depends. Can be based on book value or market value. So this is generally an overview, whatever that we are going to see. Now let's look into the formulas, and after which we will proceed with the questions. So the first thing being, how do you calculate cost of debentures, which can be again divided into two categories. One is redeemable and the one is irredeemable. So what do you mean by redeemable and irredeemable? Irredeemable means it will not be redeemed. So what do you mean by redemption? Redemption means at the end of the term. Like take for example, if it's a 5-year debenture, then at the end of 5 years, if it's redeemed, then in that case you will be paid either the face value or it will be redeemed at premium or discount depending on whatever the terms are. So redeemable is basically based on a fixed term. So irredeemable is something that continues like equity until then, it will not be redeemed. So how do you calculate the cost of irredeemable debentures? So here you calculate the same as interest by N. See, cost of debentures can be divided into two categories. One is irredeemable debentures and other one is redeemable debentures. For irredeemable debentures, how do you calculate it? So nothing but interest into 1 minus T divided by NP. See, this is nothing but interest by NP. So basically interest by net proceeds will give you the cost of debt for irredeemable debentures, because the cost that you incur for the debentures that you've issued is nothing but interest over here, and then since you are not going to redeem the same, redemption value does not come into effect over here. So the only cost is interest into 1 minus T divided by net proceeds. Like take for example, you're issuing a debenture, a 100 word debenture, this is the face value at 95. So this is your issue price, and take for example this issue or flotation cost that you are incurring to the tune of 2 per debenture. So what will be your net proceeds in this case? The issue price 95 minus your issue cost of flotation cost, which is 93, will be your net proceeds. Net proceeds is nothing but the proceeds that you receive by issuing debentures. And interest, for example, take for example this is a 10% debenture. So interest usually will be calculated on face value, not on net proceeds. So interest will be nothing but 100 into 10%, which is 10. So before that, take for example there is a 1 lakh rupee debenture at 10% rate. What will be the interest? It will be 10,000. Now if I need to calculate this 10%, now how has this 10% come? Can bring this down, so that will come to 10,000 by 1 lakh, right? So which is nothing but interest divided by net proceeds will give you the cost. So basically how much interest are you paying on the net proceeds will give you the interest percentage, that is cost of debenture. And why are we subtracting the tax effect over here? Because interest is a tax deductible expense. Like take for example you earn profit, or okay, let's start from the first over here. Take for example sale, you sell goods for 100 minus take for example all the expenses are 50, so your profit comes to 50, excluding all the expenses, excluding interest, right? Excluding interest over here. So now this is EBIT, earnings before interest and tax. Say for example is 50. Now, before deducting tax, do you have to deduct interest, or you will be deducting the interest after deducting tax? You will be deducting interest before deducting tax. For example, interest, let's say for example is 30. So EBT is 20. Now you will pay tax on this 20 and not 50. Why? Because interest is a tax deductible expense. Like if you prepare the P&L also, then you will be calculating the tax after deducting interest, because interest is a tax deductible expense. So that's why we are. So the same thing if you take for the preference shares, will not be deducting any tax over here. Will not be considering the tax effect over here. The reason being very simple: preference dividend is not a tax deductible expense. So since interest is a tax deductible expense, we will also have to consider the effect of tax. So this interest will be after tax. So how do you calculate the KD in this case? So based on the above details, if we calculate KD will be equal to interest into 1 minus T divided by net proceeds. Interest is 10, let's say for example tax is 35% divided by NP, net proceeds is 93. So 10 into 0.65 comes to 6.5 divided by 93, so that should give you 6.99% will be the KD in this case. So what about redeemable debentures? Redeemable debentures formula slightly differs. It's nothing but interest into 1 minus T plus RV minus NP divided by N divided by RV minus NP divided by 2. What is meant by this? See, in case of redeemable debentures, you also get the debentures redeemed, right? So you get the debentures redeemed. So in this case, there are two costs that you are incurring. One is interest into 1 minus T as usual. Interest, you are going to pay interest plus also redemption value minus net proceeds divided by N. So what do you mean by this? For example, this debenture face value is 100. You are issuing the same at par value only, face value so 100, and then you will be redeeming the same at 105. If you are redeeming the same at 105, then you will have to pay extra 5 because issue price is only 100. The redemption value is 105. Let's take for example this debenture is for a term of 5 years. So this debenture's term is, let's take for example 5 years. So in this case, how do you calculate KD? It's nothing but interest. Interest, same 10%. Let's take same 10%. So 100 into 10% will be 10 into 1 minus T. Let's say for example it's 35%. Tax rate is 35%. Plus redeemable value is 105 minus your net proceeds. Net proceeds at the time of issue is 100, since we have issued the same at par value, face value only, divided by, see this interest that we have included, right? Interest into 1 minus T. Whether this is for. So let me ask one question to you, which is nothing but, so this interest is whether it's for the whole year or whether it's for the entire term of 5 years. It's for a year, that is it's per annum. Similarly over here, 105 minus 100, this is for the entire period of 5 years, it's not for 1 year. So we will have to divide the same by 5. The extra 5 that you're paying is after 5 years. So you have to calculate the additional amount that you're paying for 1 year divided by, let's not take net proceeds over here since we also have redeemable value. Let's take average value of both. So RV, which is redeemable value, is 105 plus NP, net proceeds is 100 divided by 2. So that should give you 6.5 plus 1 divided by 102.5. That should give you 7.32%. Will be okay. So this is how you calculate for the redeemable and irredeemable debentures. Very simple. For redeemable debentures, we do not have RV, so we have to calculate the cost of debentures as interest into 1 minus T divided by net proceeds NP. And for redeemable debentures or convertible debentures, we will have to use approximation method. So this method, the formula is nothing but approximation method. But what is the most accurate method that you can probably use is IRR. You will have to calculate the IRR. It's something that we will see later on. Okay, let's see the concept of no. So this method that you're using for redeemable debentures, which is interest into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP by 2. This is your approximation method. But which is the most accurate method then? For that you will use this approach, IRR method, YTM approach or present value method. So what you will have to do over here is you have to identify all the cash flows, inflow and outflow. You have to calculate NPV at two different rates. Now this is based on your assumption, and then you have to calculate IRR based on the formula. Lower rate plus NPV of lower rate divided by NPV of lower rate minus NPV of higher rate into higher rate minus lower rate. So IRR is a rate where your present value of cash inflow will be equal to present value of cash outflow. So this is nothing but IRR is the rate where your NPV will be equal to 0, because since your present value of cash inflow and outflow is 0, NPV is nothing but present value of cash inflow minus present value of cash outflow. So therefore that will turn out to be 0. Basically you're calculating the return over here using IRR method. So if nothing is mentioned, you can use full approximation method. Let's see in the upcoming questions. We'll solve one by one. Okay, now we'll proceed to the first illustration over here. So illustration 1. So let's solve all these questions, illustration and QIQ questions, everything one by one. So illustration 1. First thing is, 5 years ago, see, we are going to read the questions over here, and then we are going to identify what all data is given, what needs to be calculated, and how we can approach. So 5 years ago, so illustration 1 has been given 5 years ago. 5 years ago, Sona Limited issued 12% irredeemable debenture at 103 at 3 premium to their par value of 100. Current market price of these debentures is 94. If the company pays corporate tax at the rate of 35%, calculate the cost of debenture capital. Now, how do you calculate this? Basically, first up, before calculating the cost of debenture, we need to know whether it's redeemable or irredeemable. Over here, it's irredeemable debenture. So what formula are we going to use? Interest into 1 minus t divided by NP. So interest, for interest we need to know the par value, face value, which is 100. Right, so what all details are given, and then based on that, interest is nothing but par value. Interest is 100 into how much percentage? 12%. So that will be 12. And tax rate is nothing but 35%. And what about the issue price? Issue price is nothing but, see, 5 years ago it was issued at, one thing that we need to be very careful about is that, see here, 5 years ago the debentures were issued at 103 at 3 premium. This issue price, now you tell me, is current issue price today or 5 years back. 5 years back it was issued at 103. Today current market price is nothing but 94. This is what we need to take. We are calculating the cost of debt today, not 5 years back, right? So we need to take this issue price, which is 94, and not this 103. So how do we calculate KD? It's nothing but interest into 1 minus t divided by net proceeds. So interest is nothing but 12 into 1 minus 0.35 tax rate divided by NP is nothing but net proceeds is 94. How much do we get? You also calculate this simultaneously. 8.30% will be the cost of debt. I hope you're clear about this. Okay, let's move to illustration 2. So here, company has issued 10,000 number. This is not 10,000. So this is not 10,000 rupee debenture, 10,000 number of debentures, 10% debentures of 100 each, which means total value of debentures 10,000 into 100 is nothing but 10 lakh. So rupee 10 lakh debentures at 10% at a premium of 10%. They have issued at premium of 10%, which means issue price equal to 100 plus 10% premium, so that should be 110. On 1st April 2023 to be matured on 1st April 2028, which means that the term of debentures is basically 5 years. Debentures will be redeemed at par on maturity. Complete the cost of debentures assuming 35% as tax rate. Now tell me whether this redeemable or irredeemable debentures. This will be redeemed, right? So these are redeemable debentures. So we need to calculate. You also calculate side by side, right? So when I'm doing, you also take your note and calculate. We'll be doing all the illustrations, all the TYQ questions for all the chapters in a and also in tax. See over here, these are redeemable debentures. Now let's calculate, right? So then now let's. Okay, so how do you calculate KD? KD is nothing but over here it's redeemable debenture. So interest into 1 minus T plus RV minus NP divided by N. This term in term of debenture. N is nothing but term of the debenture term or tenure. So divided by RV plus NP by 2. How do you calculate this? So interest into 1 minus T. How do you calculate the interest? It's nothing but face value is 100 into 10 into 10% rate. Rate is 10%. So 100 into 10% will be nothing but 10 into 1 minus. How much is the tax rate? 35%. What about the okay? So 35% into 1 minus 0.3 plus RV minus NP. RV is nothing but redemption value. So at what value are they going to redeem? It will be redeemed at par, right? So it will be redeemed at par, meaning it will be redeemed at face value of 100 only. Minus net proceeds. So what is a net proceed? Are there any issue cost or flotation cost to be reduced? No. So they've issued it 100 plus 10% premium, that's 110. So 110 will be your net proceeds that they have received at the time of issue divided by N. N is total term of the debenture is 5 years. They issued on 1st April 2023 and it will be redeemed on 1st April 2028 divided by RV. RV is redemption value plus net proceeds 110 divided by 2. So if we calculate this will be 4.5 divided by 105. So that should come to total of 4.29% is your cost of redeemable debenture over here. 4.28 or 29 as a case may be. Okay, let's move on to the next question, which is illustration 3. So company has issued over here. Company has issued 10% debentures of 100 each. So total value of debentures 10,000 into 100, that will be 10 lakh. So 10 lakh debentures. 10 lakh debentures. 10% is interested at par. They've issued at par. So the issue price is 100 on 1st April 2018 to be matured on 1st April 2020. So now let me tell you, the term will be 10 years, right, from 1st April 2018 till 1st April 2028. So the company wants to know the cost of its existing debt on 1st April 2023 when the market price of these debentures is 80. Okay, so cost of existing debt, they are asking you to calculate so since they've given the maturity date, it clearly means that this is a redeemable debenture. It's not an irredeemable debenture, something that will not be redeemed, right? So here it will be redeemed. So this is an example, redeemable debenture. Market price is 80. Compute the cost of existing debentures assuming 35% tax rate. Okay, so they've issued at 100 on 1st April 2028. They're asking us to calculate the existing debt on 1st April 2023, which means this is after 5 years, right? So 18, 19, 20, 21, 22, 23. So they are asking you to calculate. They've issued on 1st April 2018. Now we are standing on 1st April 2023. This will be redeemed on 1st April 2028. So already 5 years have gone, balance 5 years are there. We are required to calculate the cost of debt on this date and not on 1st April 2018. So issue price on 1st April 2018 was 100. This is not to be considered. So we will take the issue price on net proceeds today, which will be nothing but 80. That is current market price, right? That's something to be considered. And what about the redemption value? It will be matured at par. So which means that they will be redeeming. Redemption value will be at par, that is 100, right? So let's calculate the cost of debentures now as on 1st April 2023 and not on 1st April 2018. So that's why there will be like some problem when it comes to the part of taking the appropriate value for net proceeds, because net proceeds, if you're calculating, if you're calculating the KD as in 1st April 2018, we will have to take the issue price on net proceeds today, that is 1st April 2023 and not earlier, right? So that's something to be considered. So let's take all the data. Net proceeds today will be 80. Redemption value is 100. So net proceeds equal to 80. Redemption value is 100. What the interest rate is 10%. Tax rate is 10% and face value equal to 100. So how do you calculate this? This is redeemable debenture. So using approximation method, it will be interest into so it will be interest into 1 minus t plus RV minus NP divided by N whole divided by RV plus NP by 2. So in this case, cost of debt equal to interest. Interest, how much is interest? 100 into 10%, which is 10, into 1 minus tax rate, which is tax rate is 35% already. Tax rate is 35%. Plus RV is nothing but over here it's 100 minus NP is 80 divided by N. How much is N? N is nothing but number of years, right? So that will be 5. Why 5 and not 10? Because it was issued on 1st April 2018 and it will be redeemed on 1st April 2028, right? But we are standing currently on 1st April 2023 and the remaining term is only 5 years and not 10 years, right? So we are calculating the cost of debt as of today and not 5 years earlier. So 100 plus 80 by 2. See the question, what have they given? Compute the cost of existing debentures. Existing debentures on 1st April 2023. See, here what have they given? You have to calculate the cost of existing debt on 1st April 2023. Right, today. So we calculate this 10 into 2.65. 6.5 minus 80 divided by 5 before divided by 100 plus 80 by 2, that will be 90, right? So 6.5 plus 4 divided by 90, so that should probably give you 11.67%. So before moving on to the next question, let's see a few more formulas and then proceed with the next one. Value of bond when bond is amortized every year. Now how do you calculate the value of bond when it's amortized every year, right? So in that case you will have to capitalize each and every year's coupon and inflow, right? So how do you do that? See here you are calculating KD as nothing but interest into 1 minus T divided by net proceeds. Or let's take for example 1 lakh debentures of 10% will give you 10,000, right? Now if you have these information, that is 10,000 and 10%, how do you calculate the value of debentures? Nothing but 10,000 by 10%, that is you are capitalizing the income or interest by the way is 10,000 or cost of whatever that may be, and cost of debt is 10%. If you capitalize the same, you will get your value of debentures. So similarly what you do over here is that usually, how do you calculate value of asset? So value of asset is nothing but present value of all its inflows, cash inflows, right? So that's how you calculate the value of asset. If at all the bond is amortized every year, so what do they mean by that? So bond is amortized every year means, so like take for example if you depreciate your asset every year, in that case 1 lakh minus for example 10%, then it will become 90,000. 90,000 minus 10,000, next year it will become 80,000 and so on. Similarly, if a bond is amortized every year, like take for example, initially the bond is issued at 10,000, term is 10 years, right? So what usually happens, and at 10%, so Usually what happens is that every year interest will be paid, right? So 10,000 into 10%, so 1,000. Every year you will receive, if you are an investor, you will receive your interest every year. And at the end of 10th year, you will be getting this interest as well as your redemption value. But if the bond is amortized every year, like take for example, the bond is amortized equally, then in that case, every year you will be given interest of 1,000 along with the redemption value. Instead of that redemption value getting paid at the end of the year, it will be paid every year, right? So in that case, your interest amount will also differ. Do you agree with me? So see, for the first year, if interest of 1,000 is paid, you will also get your principal of 1,000. Alright, and notice that the next year, when you calculate interest, it will not be on 10,000 because 10,000 minus 1,000 has been already redeemed. So there's only balance of 9,000. Now interest at 10% will be calculated on this 9,000 and not 10,000. So it will be 900, and then 1,000 interest will be redeemed. So next year, for the third year, it will be only 8,000. So 800 interest will be paid, 10% on 8,000. Next year, principal will also be redeemed, and so on. So in this case, total cash inflows will be as follows. For year 1, it will be 2,000. For year 2, it will be 1,900. For year 3, it will be 1,800, and so on. Now, how do you calculate the value of bond? So this you will have to amortize every year. Or amortize this, you will have to capitalize every year. You have to find the present value of cash flows so that you can find the value of bond. So if you have multiple cash flows like this, then in that case, how do you calculate cash flow for year 1 divided by 1 plus KD per 1, cash flow for year 2 divided by 1 plus KD per 2, and so on. So these are the, see, very simple. These are the cash inflows. But you cannot add them and find the value of asset because this is received at the end of first year. So you have to find the present value of the same. This is received at the end of second year. So you have to find the present value for second year. For third year, you have to find the present value of third year, and so on. I hope you're clear about this. It's nothing but the value of bond or asset is generally present value of all its cash inflows. So cash inflows for bond will be, from an investor point of view, it will be your interest and then the redemption value. If it's amortized every year, then a part of the principal will also be retained along with your interest. So you will be getting your, the C is nothing but both your interest and principal since it's amortized every year. So you have to take the present value for the first year, for the second year, and so on till the end of the term so that you can find the value of bond. This is only when the bond is amortized every year. Cost of irredeemable preference shares. Now moving to the part of preference shares. See, what do you get for debentures? So preference shares again can be divided into, so if you were to find the KP, which is cost of preference shares, right? So cost of preference shares. How can you calculate the same? See, this can be divided into two categories, one being redeemable and irredeemable. It is calculated in the same manner as that you do for your debentures, but the only thing being here since preference dividend is not tax deductible, you will not include the tax effect, that's all. So here it's nothing but preference dividend by P0. P0 is nothing but value of preference share. So dividend upon preference share will give you how much percentage of dividend you are paying on the value of preference share. And for irredeemable, this is for irredeemable. For redeemable, how do you calculate? Since there's also redemption value, same thing, preference dividend plus redemption value minus net proceeds divided by N, term of the preference share, divided by RV plus NP, redeemable value plus net proceeds divided by 2. So this is how you will be calculating. For irredeemable, you need to calculate the same as PD by P0. Only thing is 1 minus T, here there is no 1 minus T since it's not tax deductible. And here it will be PD plus preference dividend plus RV minus NP by N divided by RV plus NP by 2. Okay, so let's solve few more questions based on this. So moving on to illustration 5. RBML is proposing to sell a 5-year bond of 5,000 at 8% rate of interest per annum. The bond amount will be amortized equally over its life. Calculate the bond's present value for an investor. See, here the bond will be amortized equally. So what we need to, how can we calculate? C1 by 1 plus KD power 1 plus C2, cash flow year 2 plus 1 plus KD power 2. Here the bond is amortized equally. So you will have to take the present value. You have to take the present value of each year's cash flow so as to find the value of asset. So how do you calculate this thing? but here it's amortized equally. So 5-year bond 5,000 will be amortized equally, which means that every year you will be paid 1,000 along with interest, right? So interest rate is 8% per annum. You have to calculate the bond's present value for investor. If he expects minimum rate of return, investor's expectation of return, this 6% is nothing but your present value factor rate, right? So based on this, how can we calculate? So let's take year 1, 2, 3, 4 and 5, right? So interest, what will be the interest amount? For the first year it will be 5,000 into 8%, which will be 400. Along with that, you will be receiving your principal every year. So total cash flow, this will be a total cash flow and present value factor, so that you can calculate present value for the cash flows. Principal every year you will receive 1,000. For the second year, you will have to be calculating your interest not on 5,000. Over here, in the second year, you have to calculate the interest on 4,000. 4,000 at how much percentage? 8%. So that will give you 320. And for the third year, already 2,000 would have been redeemed. So therefore, it will be calculating 3,000 at 8%. So it will be 240. For the fourth year, already 3,000 would have been amortized. So in this case, would be repaid. Have been repaid, right? So now it will be 2,000 into 8%, that will be 160. And for the last year, it will be 1,000 into 8%, and that will be 80. What about the total cash flows? It will be 1,400. The next year it will be 1,320. The next year it will be 1,240. The next year it will be 1,160 and 1,080. So what about the present value factor at 6%? Since investor expects a minimum rate of return at 6%. So that will be 1,400 into 6%. So, 1 divided by 1.06 will be the present value factor for the first year. With 0.9434. Second year will be 0.8899. For the third year it will be 0.8396. For the fourth year it will be 0.7920. Fifth year will be 0.7473. So based on this, if we calculate, let's calculate this in the next page. For the first year, second year, third year and fourth year, let me calculate the present value of cash flows over here. So it will be nothing but 1,400 into 0.9434, so that should give you 1,320.76. The next year it will be 1,320 into 0.8889, 1174.67. So the third year it will be 1,240 into 0.8396, so that should give you 1,041.10. And for the fourth year it should be 1,160 into 0.7920, so that should give you 918.72. And for the fifth year it should be 1,080 into 0.7473, so that should give you 807.08. So if you add all of this, you'll be getting the present value of the cash flow. That is, these are, so this is basically C1, C2, C3, C4, C5, and we are dividing that by 1 plus KD power 1. KD power 1 is something like 1 by 1.06 power 1, power 2, power 3, power 4 and power 5. We are adding all of them so that we get the total value of bond, which is the present value of all the future cash inflows. This is nothing but the exact value that we have gotten, which is 5262.62. Right, we have gotten 5262.33. Right. So I hope you are clear with this. If at all the bond is amortized equally, then in that case, how do you calculate the value of bond? You have to take the present value of all the cash inflows separately. This is because each year the interest will differ. When the principal amount is going to remain the same, the interest will differ, and you have to calculate that accordingly. Find out the cash flows for each of the year. Take the present value so that you can, because usually you see the value first, it will be the present value of all the cash inflows. So you take all the cash inflows separately. One important thing is interest will definitely vary because every year a part of the principal is also getting repaid. You paying that back as well. So interest amount will be calculated on the outstanding amount only and not on the original or the initial amount, right? Okay, next we move to illustration 6 and 7. So illustration 6 and 7 is nothing but 6 we will have to see. Okay, they've issued 2000 XYZ Limited, they issued 2000 10% preference shares, 100 each at 95 each. So this is your issue price or P0, which is your mark value of preference share. So this is nothing but par value or face value of preference share. So you have to calculate the cost of preference share. Here they have not mentioned anything. So let's assume this is irredeemable only. They have not mentioned anything about redemption over here. So it's irredeemable debenture. How do you calculate cost of preference share in case of not a redeemable debenture? Sorry, I'm sorry, this is irredeemable preference share. So how do you calculate in this case? Cost of preference share will be equal to preference dividend by P0. How much is the preference dividend? It's nothing but 100 into 10%. You will calculate the dividend or interest always in the face value only. So it will be 100 into 10%, that should be 10, divided by what is the P0 value of preference shares. So over here, this is 95, right? 95. So that should be equal to 10.53%. So moving on to illustration 7. See, illustration 7 we have over here R Energy Limited is issuing preferred stock of 100% with stated dividend of 12, flotation cost of 3%. Then find out the cost of preferential. Now my question is whether anything is mentioned about redemption. No. So here also we will assume that this is irredeemable preferential. So how do you calculate the cost of preferential in case of irredeemable preferential? It will be PD by P0, preference dividend by value of share, value preferential. Preference dividend over here is something but 100 into dividend has been directly given as 12 rupees, so we'll take that, divided by P0. P0 is nothing but, see, they've issued at 100 per share at a flotation cost of 3%. So 100 minus flotation cost of 3%. See, what do you mean by flotation cost? Flotation cost is nothing but to float the securities. Company is incurring certain cost. Right, so that cost will be reduced so that you can calculate the value of share. Because value of share you issued at 100, but you also incurred 3% for flotation cost or maybe issue cost, right? So that is a cost for you. So therefore, value of preference share is not 100, it's 100 minus 3%, which is 97, right? This is the cost for the company, so it will be reduced in the net proceeds. So 12 by 97, and that will give you 12.37%. Moving on to illustration 8. So illustration 8 is all about, again, preference shares, cost of preference shares, 2000 preference shares, XYZ Limited issued 2000 preference shares, 10% preference shares of 100 each, which is the face value. At 95, this is the issue price. Company proposes to redeem. So now tell me whether this is redeemable or irredeemable preference shares. This is a redeemable. So redeemable, they are issuing redeemable preference shares. Right. So this is redeemable preference shares at the end of 10th year from date of issue. So this will be redeemed at the end of 10th year. So term is nothing but 10 years. You have to calculate the cost of preference share. How do you calculate cost of preference share in this case? This is illustration 8. Alright. See, illustration 8, wherein you have to calculate the cost of redeemable or irredeemable. It's redeemable preference share. So it will be PD, preference dividend, plus this is one cost for you. Apart from that, redeemable value minus net proceeds divided by N, the whole divided by redeemable value plus net proceeds by 2. So how much is the preference dividend? How much is preference dividend in this case? It will be 2000 into 100 into, you'll be calculating. See, remember one thing very clearly, dividend and interest will be always calculated on face value. So 100 into 10%, that will be 10, plus How much is the redeemable value? They will be redeeming the same at the end of 10th year. Nothing is mentioned, so we'll assume that it's redeemed at par only. Minus net proceeds is 95, right? Yeah, 95 is issue price. And there's no the flotation cost or anything to reduce from here. Divided by how much is the term of preferential? 10 years, right? 10 divided by redeemable value plus net proceeds divided by redemption value. Some proceeds by 2. So that should give you 10 plus 100 minus 95 is 5 by 10 is 0.5 divided by 100 plus 95 by 2. That should give you 97.5. 10.5 divided by 97.5. Will give you 10.77%. So this will be a cost of preference shares. We are moving on to illustration 9. For that, I think you have to see a few more formulas and then work out these sums, which we will do in the next video. Thank you.